This is Changemakers with Katie Gore, finding the right solutions for the affordable housing community.
This week's Changemaker is Kyle Kamrooz, the founder of Bonus Homes, who's redefining affordable housing by empowering families to grow wealth through home equity. His groundbreaking model turns homes into lifelong assets, blending innovation with real-world impact. Kyle, welcome to the show.
Thanks for having me, Kate.
It is great to have you, and I am so excited to talk about home equity, home ownership, and all of the nuances of your model and exactly what you're doing. But I love to start these podcasts by first asking, how did you come into this industry? How did you first start? Just tell us a little bit about your journey through recognition or just a creative spark of energy.
Yeah, I think I actually I'd been in housing. I tell people I don't know a lot of things in life, but housing's my jam. I've been in housing since the late 90s. I was 18 years old. My father got me into lending. I didn't want to do it. I wanted to go do mergers and acquisitions in Wall Street. That was kind of my thought. And I ended up getting into lending in mortgages, and I was fascinated by that. And then rode the wave in the 2000s, when a lot of people were obviously buying homes, avoided a lot of those interesting types of loans that obviously cause a lot of issues,
Mhm.
but really learned the mortgage process. And that helped me really understand. And what was unique was I started from the back end. I started from like the selling of a loan, then capital markets, underwriting, operations, and then all the way up to the point of sale with the consumer. Fast forward from there, built several lending companies and broker shops, some of the largest broker companies in California at the time. Then became a national lender, where I had 50 branches in 50 states. And then you had the 2008 financial crisis, right? And so during that time, I got out of the industry around 2007. But everyone felt the impact, and it was an eye opening experience for a lot of people. Um, and so, but I loved finance, and I loved just the lending and the finance. I was very fascinated with mortgage, and I was very fascinated with technology, and lived it. I breathed it every day. By that time, I did, hundreds of billions of loan volume throughout my career at that time. And then I had a fascination with learning how to code. So I started to learn basic JavaScript coding, coding for dummies and some YouTubes and stuff like that, and took some classes. Anyways, I did some basic coding because I saw how painful the mortgage process was and how manual and subjective everything is. And not just the paper intensivity for the consumer, but also the back end for the lender was just mind-blowingly manual. Everything was legacy systems and so forth. And then this is now started to go into ushers in a digital age where you can start like leveraging data to make intelligent rules, right? And that led me to start a company called Cloudberga, which allowed me to get into basically the software technology space and doing something I loved and I was very deeply passionate about, which was automating the mortgage process and seeing how we can reduce the total cost of getting a loan and making it a lot easier by making everything data-driven, intelligent-driven, mobile-friendly, etc. So built that company. We had 10 of the top 30 lenders in the country that were using that platform. So now I was on the other end of it. So I was able to be relatable to some of these banks and lenders, these massive lenders, because I lived it. And I did that. And then basically in 2021 during COVID, didn't plan on this, but we ended up getting acquired by Stewart Title. And that was that. So that was kind of the mortgage side. Bonus really has been something that stemmed from really my years of just being in this industry, seeing the mortgage side, the real estate side, the buy side, the sell side, understanding all of those, right? And then starting to decouple them. And really the last part, the bonus has always been my passion, but all the stars didn't really start aligning until several years ago. But the premise of bonus really started from just this concept of every time I can't tell you how many people, and you might have had people yourself that have had this, which is they basically look back on their house on Zillow when they sold it a decade later, right? Or they sold it a decade ago. And they look back and they're like, honey, that house is now worth $800,000 and we sold it for 350.
Mhm.
And you're just like, oh my God, if only I would have kept that home, how much more wealth I would have had. That happens every day, all day. I encourage, like, what was the home value of your childhood home? Whether you owned it or rented it, is it worth more today than it was back then? 1000%, right?
Right.
So one core principle has always been throughout my journey in home ownership and in just this ecosystem of housing has been homes are the most predictable wealth generator ever. Okay.
Yep.
Regardless of downturns. I mean, we had the
Right.
worst in 2008 to 2010. Markets were just crushed. But look what has happened even when the market was that bad. Can it happen again? Yeah, although I disagree and say it won't happen to that extreme for a myriad of reasons. But m real estate, if you hold it for a long period of time, you will always win. You always will win. The problem is, so that's core principle 1 that I learned throughout this journey. Core principle number 2, the only option for most middle America and what Bonus is really focused on is bringing wealth back to the middle class because,
Mhm.
frankly, there is no more middle class. We do not have a middle class in this society. When I grew up in the 90s and the 2000s, they're somewhat of a middle class. It is massively different than what I saw
Yeah.
from when I was a kid. Um, the rich got richer and everybody else. And it is a massive gap of what's going on. And so the middle class is what built America. And at the end of I grew up middle class. And at the end of the day, what we're trying to do is that this middle America is unfortunately being locked out of being able to generate wealth because when they want to move, okay, rich people and the wealthy, when they move, they've got options. You know what, Katie, we can keep this house because we've got extra cash that we could put towards a down payment on a new house. Or you know what, Kate, I'm good. We can still go ahead and buy this new house and afford both houses. Turn this into a second home. Turn it into an Airbnb. Rent it out. Whatever. Right? Wealthy people have choice. Middle class, most people, and when I'm talking about middle class, I'm talking houses between 300, I would say 200 to $500,000 home values. Okay. A lot of people don't have choice. Why? Because if they want to go buy a new house, they need to put down money. And they want to, especially in a market like this where rates are higher, they need to put more money down, right? They can't just do a 5% down loan because their mortgage is going to be a really high
Right.
payment, especially in this market. But regardless, most people, even when the rates are down, most people take that money from an old house and they put it towards a new house. And they might pay off some debt, right? They say, hey, let's pay off the car. Let's do this. Use it for part of it for a vacation. And then let's take the remaining balance and let's go buy a new house.
Mhm.
That's what most people do. What and in order to do that, in order to get all your equity out of your house that you built up over the years, what's your only option? Sell. Because you can't do a line of
Right.
credit. You can't do a home equity, again,
Right.
home equity line of credit, a second. There's these tool, home equity investments, HEIs. You can't do any of those things. You can't do any of that because no one's gonna give you 100% of your equity out, right? So what are you left with? 2 options. 1, sell.
Right.
2, keep the house and turn it into a rental, okay, but you can't get your equity out.
Mhm.
So, if you think about it, millions of people are literally have no choice other than to sell. Because
Mhm.
most people don't wanna be a landlord, most people don't
Right.
wanna rent their property out, but guess what everybody agrees on? This house, whether they like it or not, right? This house will be worth more in most markets, in most areas. This house will be worth more in the future than it is today.
Right.
But you only have one choice, which is selling.
Mhm.
This is why Bonus was created because I saw in 2010 my father, and this is the story that it is really the why. I saw my father have to sell his house for $500,000 in 2010, and he had to sell it just because he needed to move. He had
Mhm.
to move. He had about 100,000 of equity in there. Well, he couldn't do anything. He can't get a mortgage or anything like that.
Right.
He knew, and he's in real estate, by the way. My father, he's like, God, this house is going to be worth double in a decade,
Yeah.
if not sooner. I know this, and it pains me to get rid of this home, but I have no choice. I can't rent it out because I need the 100,000 to go buy down the new house, right? So you're in this little rat race, right? That house today is worth 1.2 million.
Hmm.
Okay. My father, if he would have been able to do a program like bonus, he would have been able to have an extra $300,000 to $400,000 of new wealth that he would have had beyond his $100,000.
Mhm.
And for a 73-year-old man, right? And my dad, love my dad, but he's not in the best of situations as far as
Yeah.
financially goes, right? That is a lot of money. That's a
Mhm.
lot of money. So we created a product that in essence gives you another choice other than selling your home. And we really created a new category called, basically it's called a home appreciation partnership. It's a HAP, HAP. And really what this category allows us to do is exactly that. It allows us to cash out all of your equity as if you sold it, but you're not selling it. We then turn your property into an investment property. It's an asset and it becomes a passive investment for you. So now you get all your cash as if you sold it,
Right.
not a debt. It's not a loan. This is an investment. There's no interest rate on it.
Mhm.
So, right? You have a $500,000 house, you have a $300,000 mortgage. And by
Right.
the way, that mortgage, you have a low rate of 3% because most of America right now is sitting on this low 4% interest rate. And guess what they're doing when they're selling it? They're getting rid of gold
Mhm.
because that low rate, which we'll probably
Yeah.
never see again, that low rate is literally the best lever that millions and millions of homeowners have today. I have a
Mhm.
2.5% interest rate on my house.
Whew.
That is gold, right? And you
Yeah.
have millions of people who have great rates on their house because of what happened during 2017 or 18 and 2021 with all the rates going
Right.
down as low as they did. So you got this really unique advantage here for people who have a rate below 4%, to be able to now do this bonus, which I'll go back to it is $500,000 house, $300,000 mortgage, you have 200,000 of equity. So typically when you sell it, you're gonna get your 200,000 minus
Yep.
your seller agent, buyer agent, transaction fees, all that stuff. And then you got the pain of this uncertainty of listing your home on the market,
Mhm.
right? Showings on the weekend, a buyer backing out, all those things. You got so many unknowns. We come in, say, we'll cash you out. You'll get your cash in 2 weeks. Don't
Mhm.
need to show your house. Give you the $200,000 less in fees because we're not an agent. You can bring an agent. An agent can also
Yeah.
have if it representative or you come direct. And we'll cash out your $200,000. You move out, and we're super flexible on how you move out. Timing, it's up to you. And we've had people that bought a new house and it's a new construction and they're not out for 4 months. That's okay. We still do the deal and you're still in the home. We're not going to kick you out or like that. These are for people who want to move. They're already decided
Right.
we need to move for whatever life brought to them. Now you got your 200,000 in cash. You move out. Bonus. Now, in essence, we gave you the $200,000. Bonus says, I'm gonna give you the $200,000. I'm gonna now take and manage this property on your behalf.
Hmm.
I don't own
Okay.
the house. We are not on title. We do
Right.
not take the property. This isn't any type of, wonky creative financing like a subject to
Right. Right.
or alternative like wrap mortgage. This is none of that.
Yeah.
This is truly, and again, there's a reason why I'm in DC. I'm spending a lot of time with Congress. There's really no holes in what I'm about to say. And here's why. You are still on title. So Katie, you still own the home.
Right.
You now moved on with life. You now have it as an investment property. And you still can qualify if you wanted to get a new mortgage, you can still qualify. People say, well, how do I do that? Because I have this other home and I have this new home. Well, in mortgage world, you can do that all day long as long as either you can either qualify with your income or you can offset this because this can be a rental property. So
Hmm.
there's guidelines around that where we can offset it. So totally
Yeah.
fine. So it's not going to disrupt your ability to get a new home. So you're good
Right.
there. You now moved on. We turn this property into a rental property. You never pay another dime on this house again. So the idea of you being a landlord is gone. You now have a rental property, but you're not really a landlord because bonus is handling everything. We handle all payments on the house we
Mhm.
make. We cover any issues with the tenants. We pay any fixes. It's all on us. You move out and the roof caves in five days later. That's on us. Okay. 3 years later, the HVAC blows up. Okay. You're not going
Yeah.
to get a call from bonus and saying, Katie, we need $1,800 to fix the
Right.
HVAC. That's not gonna happen, right? We cover everything, it's in our contract. So there's no out of pocket for you. You've moved on with your life
Mhm.
and enjoyed it. And you've taken that $200,000, whether you bought a new house, whether you've traveled the world, whether you're renting, whatever you wanna do. You do whatever you want. It's your it's your money, right? And bonus is now managing this asset. And then after 5 years, up to 30 years, remember, this is a long-term hold.
Yeah.
You have the choice. It's your home. You have the choice on when to sell it.
Hmm.
And at the time of the sale, you're going to get a third of all the future appreciation from the time that we did the transaction today to what it's worth when you sell it. That makes
Wow.
sense?
Yeah. Yeah. Interesting. It's kind of like, I'm going to simplistically say this, but it's like you've taken this middle class wealth building concept. You've been able to realize real estate is going up in value, but yet you're putting it in the piggy bank for that future day, aren't you?
That's exactly right. Well, and here's the thing. This isn't taking money away from people today to
Yeah.
say save, like a
Yes.
401k, or when you invest in an
Right.
IRA, when you invest in something, it
Right.
requires you to take money today,
Hmm.
put it into an account, and then wait for tomorrow.
Yeah.
Here's the difference here. I'm giving you all of your money today. You're cashing out that $500,000 example. You're cashing out all of your equity. There's that's it. So I gave you everything up front,
Right.
and you're not putting new money in. What we're
Right.
doing is we're not restarting the clock on your home. In other words,
Yeah.
the house now has a $300,000 mortgage, which we're going to pay down, right?
Mhm.
Again, we have that low rate. Why give that up? And it's a partnership. And then now you got this $200,000 that you have the equity on. Okay. So this isn't like, and in essence, if you look at it, we created a bonus wealth investment home, right?
Mhm.
It's like a program in essence. We're almost, this home is almost like a 401k account that's set up for you, right? Because in essence, you now have this asset that right now you've already cashed all your equity. So your equity is at a zero today. I mean, if you do this today, but that's gonna grow.
Right.
And that house might be $500,000 today, but in
Yeah.
7, 8, 9, 10 years, I bet your bottom dollar that house is gonna be 6, 7, $800,000.
Yeah.
Now your house is 800,000 in 2036, let's just say. So $800,000 home. Remember, this whole entire time, you haven't paid a single penny.
Yeah.
We've managed it. And here's the cool part. If you're worried about, well, you're gonna manage and stuff, we just gave you
Right.
$200,000 with
Right.
no payments
Yeah.
back in 2025. We would be the dumbest people in the world if we gave money like that with no interest rate,
Mhm.
if we didn't want that money to come back, and we wouldn't wanna make a good return on it.
Yeah.
So we have a vested, aligned incentive to make sure what happens, the property is taken good
Yeah.
care of, the
Yep.
mortgage is taken care of, and the
Right.
home is optimized for the
Yeah.
highest possible value, so
Right.
that when Katie and bonus later on, when you want to decide to sell it, Katie, for the
Mhm.
$800,000, we are truly like, yeah, this is probably a good time to sell. Now that $800,000 you sell it for, you're gonna get the difference between 800 and the 500. So that's
Right.
300,000,
Right.
and you'll get a third of that. So you're gonna get
Right.
basically $100,000
Yeah.
for doing absolutely nothing. And it's very similar to a 401k in the sense
Mhm.
that
Yep.
you're not actively managing your 401k. You're not
Right.
actively managing your IRA, right? You might move some mutual
They
funds
just
around, but
Yep, they just kinda piggy bank out there, don't they?
it's out there, right? I
Yeah.
mean, like you have no control on what happens to the S&P 500, right? So in essence, you're just hoping and you're giving
Yeah.
yourself time,
Yeah.
right, to allow that to grow in value.
Mhm.
It's the exact same thing with a home, but for society has never given the everyday folks who are not investors,
Yeah.
who are not property flippers, they
Right.
haven't given them a turnkey solution to allow them to maximize wealth on their home, which
Right.
I would argue is a way more predictable generator of wealth
Mhm.
than anything else. And here's the other kicker. That home that you lived in and you just moved out on, it just earned you $200,000. You
Yeah.
saw the value go up.
Right. Right.
You already saw it, you believed it. This isn't like you're investing in Bitcoin and you're
Yeah.
just like, "I
Yeah.
hope it does well." You're like,
Right.
I saw this house, it grows up, right? I
Yeah.
saw it. And I think the Mesa, Arizona is a great community. And
Mhm.
it's only going to do better over the next 10, 15
Only
years
gonna do
after,
better.
especially a
Right.
lot of these communities out there.
Right.
So that is what's so powerful. And this was like the light bulb moment for me, which was like, there literally is no home wealth manager out there.
We do a lot of talking about the extremely low income and the extremely high income, but there's not a lot of conversation. Obviously, there's not been a model in the dynamic for this middle class or
Yep.
whatever the term you want to
Yep.
say.
Yep.
So, is it just the traditional real estate industry just hasn't, they've been like, oh, be happy with the 200 equity that you had and now move along? Or
Yeah.
is it they're just people have just, like, been like, "Well, it is what it is." I mean, for whatever reason, this concept of generating wealth in the middle class, everybody's been fine with it just being the take your equity and go and hope you can make the transaction, right?
Sure. We actually just got awarded we were a winner for the Brookings Institute. So the Brookings Institute is a big think tank in
Mhm.
DC, and they had a competition that was building wealth in Black communities,
'Kay.
and we're one of the solutions because they're just like and I would argue that everyone knows building wealth is um is a multi-tenant approach, I would say, right? But not everybody can invest in the stock market. There's no
Right.
real key solutions to that. And when you own a home, look, we're not. I have a big sympathy, and I worked a lot with first-time home buyers. That's a different animal, right?
Mhm.
Getting people
Right.
into a home ownership, which is huge. Okay, that's not. We're not going there yet, right? Although we will in our second phase of bonus, which I'll talk about in a moment. What we're really focused on is, like, once you've got that house, you're an investor. You're living in the home, but you're investing in an
Mhm.
appreciating asset. And all
Mhm.
we're trying to do is just to teach folks to hold on to appreciating assets. There's things called good debt and bad debt. Bad debt's a credit card. A good debt is a 3% mortgage on your house,
Yeah,
right?
yeah.
And so the concept of these I would call it principles. Warren Buffett, the Frank Vogels of the world, right? That have this long-term approach on what do they say? Hold stocks forever, long-term hold. Don't play the market. Don't buy
Right.
and sell. Don't get emotional about it, right? If you just hold on to the stock, you will win. If you put, and or the market, right? And then Buffett had that competition during, I think it was during the recession time when he bet the big huge hedge funds that said, "I will invest in the S&P Vanguard S&P 500 $1 million. You guys take $1 million and do all the stuff that you want to do, and in 5 years, we're going to come back and we're going to see who won." Right? And all he did was like he just bought the Vanguard S&P 500 thing. He held on to it. Things started going, and then guess what? He ended up winning the competition. Right? And I think that's the principle here, which is a long-term hold. And as I mentioned, middle America, and when I say middle class, to me in this context, it's defined as people who own a home.
Right. Okay.
You own a home, you do not it is very, very, very difficult for you, for people who own a home today, a lot of people who own a home today, it is very difficult to own multiple homes.
Mhm.
And to
Right.
build wealth, you really need to kinda, ideally own multiple homes. The
Mhm.
the trouble is down payments and
Yeah.
this, right?
Yeah.
Managing, landlord, all that. And that's the reason why you only have 10% of people that, of single family homes out there, 10 or 15% are, I would call them investors, right? Landlords and whatnot, because there's a lot of that, you know, that's their business in essence that they do. Everyday people, the other 85% of the people out there, we all want to make money. We all want to build wealth for our families. That $200,000 is literally going to get sucked into the next house,
Right.
right? So you can say, yeah, now you're building wealth on the next house. Sure. But why can't you have your old house?
Uh-huh.
Like, why not? Like, why do you have to give up one in order to do
Mm.
another? That's all we're trying to say.
Mhm.
It's like you don't have to
Right.
do it, but who doesn't want more of that of that ability of that asset that you've
Yeah.
already had? And to be honest with you, what ends up happening is as you play this out, that homeowner takes the 200, buys a new house, puts in the new house, sells that one, buys the new house, sells that one. And then by the time they're 50, 60 years old, They have one home. And all along the way, if they would have only have kept those assets, how much more in wealth would they have had? How much more capital
Yeah.
infusion would they have
Yeah.
had back into their communities?
Yeah.
So so you can to going back to your question, it's a great question, which is basically that like, isn't it enough that you got your equity out? And my answer to that is no. And number one, number two, why should selling your home be the only option?
Right.
Everything else, we have
Yeah.
optionality everywhere. You go down the grocery aisle, you have 19 cereals, right? We have options everywhere. And this might not be for everybody,
Yeah.
but for people who want to build wealth and who want to have an ability to say an extra 100 to $200,000 to $300,000 of wealth for my family. So when my kids are 20 or 18 and I can pay for their college tuition, especially at that time when college tuition is going to be probably even more expensive than it is now, or life emergencies that happen and I don't have money, I can't tap into my 401k without a penalty. I can't tap into
Yeah.
my pension without a penalty. Like, boy,
Right.
I wish I would have bonused my house back then because I would have had probably another
Yeah.
$100,000 looking at what the value is today. All we're doing
Yeah.
is we're
Mm.
just giving people, the emotion. Someone asked me this question, which was very fascinating. It's the what's the emotion you describe of the people that you do? It's relief
Hmm.
because in essence, you're getting something you never would have had before, and you're
Right.
building yourself security, which we all want, for your future,
Right.
right? And by the way, not everyone's gonna have a 401k, and not everyone's gonna have all these pensions and stuff like that, right? Most people right now, the average savings for somebody, if you look at the statistics, it's startling. It's like $3,000,
Mm.
$4,000. So, a lot of these people that we will bonus their home and whatnot, um, a lot of people just in general, they don't have a savings, and this might be the only
Mhm.
vehicle for them to
Right.
build wealth for their retirement.
Right. And a lot of people who have bought a home, they believe in the area, the neighborhood. They were buying to what they hopefully could afford at the time. So, they, for whatever reason, that community was appealing. And
Yep.
so, they can tell, to say, hey, this neighborhood is up and coming. This neighborhood is stable. This neighborhood has arrived. And the values are going to just keep going up. And maybe their life has changed, jobs, size of house they need, or whatever. And so, it's interesting though, because a lot of people are not thinking as that property as a transactional investment. They are thinking of it as buy it, move up, move out, move
Yep.
on. And so
Yep.
this really changes like the transactional piece of this completely.
It does. Yeah, I mean, it's you do move up, you do
Mhm.
move out, and you do move on with bonus.
Yeah.
The only difference is you don't leave the carnage behind.
Right. Right.
You don't leave, you you sold the stock too early. If
Yes.
you only would have kept it, right?
Yeah.
You had that. You're like,
Yeah.
"Oh my god, if I would have only had not sold NVIDIA stock 5 years ago," right?
Right.
This is in essence giving you the ability for something that you know is gonna be worth more in the
Yeah.
future.
Yeah.
Um, and for those people, by the way, I'd say this, for those people who would say, "I just wanna be done with this house.
Yeah.
I don't wanna have to do it. Well, I'm still carrying the mortgage," or, "Well, it's still in my name." I hear you, and I get that. However, what I would say is we take all risk. We indemnify the homeowner from everything. Literally, again,
Wow.
it's a true partnership. So they have no one can come, no risk associated to this to them at all. Nothing. We take all of the burden on, right? Um, and I would say, okay, we took those away, and you've got that low rate, okay, and yeah, you are moving on. But if you realize it, I mean, we've got homes right now with homeowners that we've done for a couple of years. They it's been out of sight, out of mind.
Mhm. Right.
So I think, it's get to know what we do before you make a judgment on, or what someone like that does a HAP, right?
Yeah.
We're the ones who launched this category, but there will be others. And get to know what they truly will do before you just come to the conclusions of like, "I can't do it," I wanna get rid of it, because what's gonna happen later on is that house is gonna double,
Mhm.
and you would have missed out on basically free money
Yeah.
just because. And here's the thing, and we get this a lot, people say, "What's the catch? This is too good to be true." It really is, like, we're like, "Okay, I cash out everything. I don't
Yeah.
have to." to have people coming through my house. I get the cash in 2 weeks. You now manage it completely, and then I just get some paycheck later on down the road. What's the catch? And what we tell people is we're very selective on the homes that we make an offer on. Very selective in the sense that it has to be in a good neighborhood, in a good city that we believe over the long run is gonna appreciate in value, okay? Let me give you some examples, and there's a lot of them, by the way, especially post-COVID, where you've had this just movement towards
Yeah.
the Sun Belts and whatnot. We love Phoenix.
Mhm.
We love Tucson. We
Mhm.
love Birmingham, Alabama. It is a
Nice.
great market. Memphis,
Yep.
Tennessee, huge market. Elon's company, he's got his massive data center over there. I think they're building another one over there with XAI, and other jobs are coming. Memphis is a big one. Nashville, Columbus, Ohio, wonderful
Mhm.
market.
Yep. Yep.
Cincinnati's going great. Cleveland, awesome. Charlotte, Raleigh, Durham, Greensboro, um, and, Colorado Springs, Dallas, Houston. Houston's, got a lot of, I mean, well, a lot of states have insurance issues right now, Houston with hurricanes and
Yeah,
what,
yeah,
and Florida,
yeah.
but great markets. Salt Lake, Provo,
Okay.
right? These are great, great. Minneapolis, and there's more, right? We're not in every market right now. We're in about 6 to 8 markets, but these are great markets where jobs are being created over the thing. Tons of manufacturing. You're getting a ton of now investments coming in, foreign and domestic. Okay, right, and so it's going to get great. It's just going to be amazing over the next 10, 15 years, 20 years as you do this.
Yeah.
As you kind of see what's going on with the map, right? I live in California. I'm moving from California. We're not in California. We're going, obviously home prices are
Yeah.
different there, but you know,
Yeah.
I'm actually going to Arizona as well. So good quality home in a good area, right? We want homes that are taken care of. We don't wanna renovate a home. We want a
Yeah.
home that's
Yeah.
in a good area, good taken care. And I tell people, common sense. Would you want is if you were a tenant and you had a family, would you wanna live in your house and rent that for 12 months? That's our barometer. And if we say yes and we can get that, that's what we're looking for as well. And then the other thing is that you were in the right place at the right time. You got that
Yeah.
low rate during that time,
Right. Right.
and you got this gold that you're sitting on. Why not take advantage of it? Like, you're gonna benefit from it. And I think when people start hearing that, they realize that this isn't like a scam or anything like that. This is like
Right.
it's actually backed by data. It's like a good home, good area that can rent well, has long-term, and we built a lot of technology that we can what's long-term home price appreciation look like? What happens with, macro, microeconomic conditions? And the last thing is you got this mortgage. And for those people who realize the value of that low cost of capital, now you can have your cake and eat it too.
Mhm, mhm. I see what you guys are doing is kind of part of that continuum of alternate housing finance. We've had people on the podcast who have been in land banks, land trusts.
Yep.
We've had some pad split types of concepts as well, shared equity, a lot of different models. But you guys are in that continuum, but you're a completely different
Totally.
model, if you
Yeah.
will, and a completely different, target audience.
It really is, and it's like, love pad split, love some of these
Yeah,
things where it's saying, "Hey, let's take your house, or let's do some ADUs, or
yeah,
let's rent the rooms, let's optimize those things," right? For us, and again, this has just been something that's been tried and true that's been something just the principle of mine for the longest period of time is you really only have one choice when you wanna move, and it's to sell. Because most people
right.
aren't gonna rent the house. Very,
No.
very few people. And the only way to get your equity out is that. And so,
Mhm.
being in mortgage for such a long time, every cash out refinance, rate and term refinance, HELOC, second mortgage that I've ever done and seen, your LTVs are 70, 75, 80, maybe 85. And then now you've got this line of credit that's tied to prime, and then now it's tied to cost of funds, and it's tied to all
Mhm.
these indices that are woo, wobbly, right? So it's a
Yeah,
variable. So, but you still have equity in the house.
right.
And it's funny, I always was like, I help create like loan products as well. And I was like, God, I would love to just create this like 100% cash out all your equity and move out. I was talking about this like a decade ago. Well, with the maturation of shared equity, right? This concept of being able to, instead of paying a payment, share in the future upside together. That started coming out, which has been an as an awesome vehicle. We've taken pieces from that. And by the way, I don't know if you know this, but I think it's the Cal HAPA, don't quote me exactly on this, but California,
Mm.
whatever you think of California, for California, they actually came up with a model, and I'm gonna butcher the stats of this or the actual specifics, but they give people who buy a home, I think up to $100,000. Again, don't quote me. I can't remember what it was. And then again, there's a criteria around this. And then what the California government said is, we're going to record a second lien on your property. You're going to go get a first mortgage, and we're going to
Mm.
record this on your
Right.
second lien. Right?
Right.
We record a second lien as well. But California said something which was really fascinating, and this is and I think they get it. It's like, when you sell this property, you don't the payback is, we're gonna get the money back, but you're gonna give us a percentage of the upside. So until you sell this, right, and it could be 20 years from now, and I don't know the details exactly, but until you sell it, you don't have to pay anything on this. And then the state of California, because they gave you that 100,000 or whatever the dollar amount
Yeah.
is now basically working with you and benefiting from the future upside of this property. And for California, if you think about it, it's beneficial for them because they're investing in their own community.
Yeah. Yeah.
It is a powerful, this concept of sharing in the upside is a
Mhm.
powerful, powerful tool.
Mhm.
Whereas what we've lived in is, we've lived in a debt world for a very long time. If you think about my world, your world, past 30 years of going and getting money, okay, tapping your equity has been all about debt.
Right.
Katie, you wanna grab $15,000 to go, $30,000 to build your pool? Love
Yeah.
that for you. I
Yeah.
love it.
Right.
Oh, oh,
And I
well,
go
you need to pay $400 a month at an interest rate,
right.
blah, 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 blah,
Right.
blah, but you can get your money and do whatever you want with it. Well, it's
Yeah.
my money. Why am I paying more debt on it? Like, it never
Yeah.
registered for me that you are penalizing me to pull out the money out of my house
Yep.
in order for me to spend it the way I should be spending it.
Right.
Makes no sense. Makes absolutely no sense. And I don't wanna go on a tangent on cash out refis and whatnot, but what we're trying to be able to do is to say, the world is evolving, and a program like a HAP allows you to really partner. That's why it's called a home appreciation partnership. The alignment is unbelievable because we're giving all the money up front. And in order for us to do anything and make money, we gotta wait.
Mhm. Right. And it's interesting because you've got an alignment here of the markets that, several of the cities have been slowly increasing, and several of them are new to the table in the cities you were talking about.
Mhm.
So, you're seeing a really robust market. We see it a lot of times on the rents that have been going up. We've been tracking rents for a long time. You're seeing it on the home ownership side, but I'm fascinated because of the new cities to those markets,
Okay.
and they're really good cities, so they are gonna get stronger, and all the economic data is pointing to that.
Well, here's the cool here's the interesting part, Katie. We built a model. So if you remember, like, the companies like, the iBuyers and so forth, right? Again, they serve the purpose, right? Is this convenience, certainty, get out of your house
Yep,
quick and
right.
move on with life, right? They would discount your house quite heavily. But for the people who wanted to move, hey, go, you got open door, you got whatever, and take the thing and kind of move on, right? Um, but if you think about the model, and I mean, if you look at like an open door stock price or an OfferPad stock price, they're down 99%.
Mhm.
Because their model was so dependent upon, they had to flip these
Oh,
houses after
right,
they bought
right,
them, and so
right.
they have, if you think about what we've done, and again, those are good businesses, good models, they suit a specific audience. But if you think about what we've done, we wanna hold these assets for as long as possible. So
Mhm.
the ups and downs,
Yeah,
if
yeah,
Birmingham, Alabama has a crash
right.
and it goes down 12%, 13%, I mean, which is pretty big, by the way. Let's just say over the next year, okay? We aren't like, "Oh my gosh, we gotta get rid of this," or whatever. Homeowners are gonna be like, "Hey, what do I do?" And by the way, homeowner now is we're now negative. All of us are negative because the house
Yeah.
is worth less than what we bonused it for.
Okay.
What do we do?
Right.
You know what we do? We keep doing what we're doing. We rent it out, right? Because
Hold on to
rental
it.
market because rental market is always there, and we
Yeah.
actually have a huge rental shortage, which not a lot of people talk about. We are the latest is there was like 1.2 million units short on the rental side. And that's a huge market, and I would argue that's actually a very important market
Yeah.
because in order to be a buyer, you need to be a renter.
Yep.
And if you can't find rentals,
Right.
what do? You go live with your parents, you go live with
Yeah.
family. It's a
Yeah.
different world. So the rental market is gonna be there. If that house is down 13% in Birmingham, Alabama, we got 30 years.
Yeah.
Do you think it's gonna come back in 30 years?
Right.
1000%
Yep.
yes,
Yep. Yeah.
right? So we are not pressured in with a HAP in our category to have to unload or sell or do anything of these properties anytime soon. That's the reason why we tell the homeowners, we say, "You can't sell for 5 years. We gotta build up the equity again."
Right.
Right?
Right. Right.
What we anticipate and what we will see, although a lot of our houses today actually have built equity surprisingly in just 2 years. But what we will see is, and I think we're looking at this from a trends perspective, but my gut is most people will most likely 7 to 10 years will be the time frame where you're gonna optimize on this, where you can probably get between
Okay.
70 to $100,000 of new money.
Yeah.
And
Yeah.
that's gonna be a really great time where then now you can go sell that house in Birmingham, and now you're up 80, $90,000. Because remember also, even if the market's down, you're not paying for anything, it's not affecting your debt obligations, nothing in your life is changing.
I believe in Birmingham. It's an amazing city,
Have you
and
seen it? It is what they're doing some awesome stuff over there.
downtown is looking beautiful.
It's
They're
great.
building
Yeah.
beautiful, apartments. Um, One question I was thinking of when you were, talking about this was, um, w are there missing pieces to policy? I mean, you're in all these states, and, you know, are there pieces that are missing
Yeah.
that could better position what's happening, or is this just truly, the market does what the market does?
Yeah, great question. Great
Mhm.
question. So let me talk on the state side.
Okay.
So from a state standpoint, which is something, and also one of the reasons why I'm in DC, I live in DC as well now. Um, uh, National side, but also state side. There's definitely a lot of when you create a new financial category, there's a lot of education,
Uh-huh.
awareness
Yeah.
that you got to create, or people would just go ahead and be like, "I've never heard of it. I think it's a scam, or I think it's
Right.
a subject to, or are you a HELOC? Like, what are you, right?"
Right. The
And
classic, "We don't understand innovator syndrome."
that's exactly right. I mean, again, I always go back to the Airbnb, and I go there, I think
Yeah.
there's just like I was actually one of those people with the Airbnb. I'm like, "You want me to stay in a stranger's house and sleep on their bed?"
Yeah.
And they might have clean sheets, maybe, but
You're right.
you wanna pay them to do this? And and then I'm gonna take out their trash when I
Mhm.
leave and put it on the
Yeah.
front?
Oh, I would have missed it on the Uber. I would have missed it on that one too. Like,
That's
"You want
right.
me to get in a stranger's car? What?"
That's right.
Yeah.
And then if you think about with the Uber, it was like, I'll never have my kids go in an
Oh,
Uber by itself, right?
right.
Now, you're like,
Now,
Hey, Susie, Bobby, the
everybody.
Uber's here.
Yep.
Enjoy.
Yep.
Have fun in school, right? Because you see everything about the
Right.
driver. You got all the so it is fascinating. And look, we're in the early days, and we're going to experience that. That's one of our headwinds that we will experience, and we are experiencing,
Right.
because people are like, one, it's a really well structured product, well thought out. We spent a
Mhm.
ton of capital, a ton of money and time to build this. But number one, I always encourage people poke holes, and people try to, and really, we think we've done a really good job. Can we get better and better? Of course we can. Um, but the biggest thing is that again, it's like, this sounds amazing. So if it sounds too amazing, it must be too good to be true. Right.
Right.
And we're just like, no, let us tell you why it's not. So that's something that is going to be an awareness campaign as we start kind of going, right? As we get going. But getting back to your question about a policy, state level policy specifically, in markets like Florida and Texas, South Carolina, even parts of and Birmingham, and a few other markets as well. When you take a property, a primary residence, and you turn it into an investment property, your tax exemptions go up, right? Or go away.
Mhm.
So what happens is in Texas, or let's say Florida, because Texas has a homestead, but let's say Florida. You have a property in Florida, let's go call it Tampa, and the house is $400,000 today. You pay more property taxes, let's say $3,000 a year, okay? And when you turn that into a rental property, that property taxes is probably gonna go up to 6. And what makes that difficult is it makes it hard to pencil from a cash flow perspective because now your taxes just doubled, right?
Yeah.
So
Yeah.
those are some things. So those are some now states, I mean, although I know right now, obviously the governor is trying to abolish property taxes, but states that have these taxation for invest, they did it in the right mindset to kind
Right.
of push away the wrong people, right?
Uh-huh.
Like corporations and stuff like that, you know?
Yep.
But this is something different because you know, Katie who lives in Birmingham is
Right.
not giving up Katie's property in Birmingham just
Right.
because she's gonna be moving to the other
Yeah.
side of Birmingham.
Yeah.
Katie is still gonna own it, and her neighbors around Katie
Mhm.
all know that Katie still own it,
Yeah.
and she's still part of the community and the fabric of the community, and it's still her home.
Okay.
Big difference than
Yeah. Somebody
a
way
investor
out.
coming in, right?
Yes.
Or a corporation
Right.
coming in, and then you
Mhm.
lose that. And that's also another big, huge piece of this too. We're actually the anti-corporation by, being in rental property because we don't own the properties. Remember, we don't go on we do not take title. Homeowner still stays on title, which is a huge piece of this, which is also a big part of local. We're a very local product, and it's a big part of our push with creating a local community and creating wealth for that community. Most people who sell their home or move usually stay within their area, right? I mean, obviously, some people leave to the state and whatnot, but but they're still there. So, um, that is a policy I would say from a standpoint specifically like property taxes and stuff
Okay.
that obviously we would address. Um, Other than that, on the federal side, there's a lot of different angles, which I won't go into too much detail now, but there's a lot of angles on the federal side,
Yeah.
especially with I mean, look, regardless of put politics to the side, both sides of the aisle are trying to make the middle class build wealth.
Mhm.
And I mean, even just Secretary Besant just said a couple weeks ago, he's like, you know, we're trying to bring wealth back to Main Street, not just Wall Street, right? Because Wall Street has
Mhm.
already ticked up
Yeah.
massively. Wall Street
Right.
is for the wealthy, if you think about it. And that's the mentality that's been. It's been for a lot of the people because a lot of people can't invest in the stock market.
Mhm.
And
Or doesn't they can't invest, won't invest. Don't I mean, it's a very complicated
it's
path.
complicated,
Um,
100%.
yeah.
And and so when you're looking at not only just this administration, but I would also argue even the previous administration and just like I said, both sides of the aisle wanna figure out ways because
Mhm.
they all see the decimation of the middle class.
Yeah.
They have. And you can't deny it. And so and the other thing is too, just a macro perspective, the middle class, they don't have a lot of options to build wealth in the new world order, right?
Uh-huh.
And they, in essence, they are, stuck, a lot of people, with these low interest rates. They're not
Mhm.
moving.
Right.
People aren't moving
And nobody
around.
wants to give that up.
No one wants to give it up.
Yeah.
And we've actually seen people that we've talked to that weren't even thinking about getting rid of their home. They wanted to, but they
Mhm.
didn't think about it because they're just waiting for rates to come down
Yeah.
because we live in this very draconian view, which is I'm gonna give up my 3%. I'm gonna go ideally to a 5%. But right
Yeah.
now rates are 7%, so I'm gonna wait till it comes to
So wait.
5%. But
Up.
I'm gonna wait and I'm not gonna enjoy my life. I'm not gonna move
Mhm.
forward. I'm not gonna
Yeah.
experience, right? Because one thing we can't buy is time.
Mhm.
And, I've got carpe diem tattooed on my arm right here, be present. I try to live by this every day. I do a really bad job because I always think about the future too much. But at the end of the day, this is a home, right? We
Mhm.
and bonus is trying to give you the flexibility without giving you we don't
Mhm.
wanna make it punitive. You shouldn't be punished by getting rid of this beautiful asset that's gonna be worth more in the future just because you need to
Right.
move. And
Right.
and again, everything in society right now, in one way or another, makes it financially punitive for you just because you wanna go live life. And we're
Uh-huh.
just like, "You don't have to do that anymore. Go
Mhm.
enjoy yourself." And because I know a lot of people who are locked in and they're like, "Could I move?" Yeah. I think I could. I would want to move. I think, we've been here for 10 years, want to move to
Yeah.
another spot. And they're not doing it. And then all of a sudden a year passes, 2 years passes. Think about all these people who thought rates are going to come down to the fives
Right.
by now.
Right.
They've just been waiting.
Right.
And they're just waiting and
And they're
waiting. And
just
that's
waiting.
2 years
Yeah.
of their life that they
Yeah.
just missed out on.
And it's impacting the market too because of all of the supply and demand piece because you have like a whole bunch of people at this lower, interest rate. I mean, so you also see the market sort of like wondering what's going to happen too because people are waiting.
That's
So
exactly right.
that's an interesting dynamic. Yeah.
It's an interesting dynamic, right? And although we can't solve the buying in the new home interest rate
Yeah.
phenomenon, what we do solve for, if you think about it, is your dollar cost averaging when you bonus your home and you're buying in the new home.
Uh-huh.
Think about it. We did a house, you have a 2.75 interest rate. I think we closed on a house that she had 2.75 conventional, or I think it was FHA. 2.75 interest rate. She locked in with this new house, I think it was at 6.25. And she was basically literally told me this. And she's like, "Wow, I'm not a numbers person, but I basically, if you take my 2.25 that I have on this mortgage balance, it was like 200,000 on this house, and then she's got this, I think $350,000 mortgage on this new house at 6.25. She's like, "Isn't that about like an average of like a 5% that I'm paying cumulatively?" I'm like, "Bingo."
Right.
We gotta teach ways of looking at wealth as a holistic view. That's why net worth, when you think about net worth is your entire picture of you, of your portfolio. It's not just this one house. When you throw a bonus into that net worth conversation, now you get into the semantics. Low cost of capital, appreciating asset, bonus right here. Other asset, and you mix them all together, you got a pretty interesting portfolio as you start, if you've got the 401k, if you've got these other things as well too. So you got to look at this holistically to be able to do that.
And you've given the middle class the ability to be their CEO of their own real estate investment
100%.
portfolio,
That's
which,
exactly, and that's
you
well
know,
said.
I mean, and they haven't really been able to have that, as one of their own wealth building. And it took me a minute to figure out wealth building when it comes to generational wealth. I come from an incredibly, poor background, so it took me a minute to get this concept, but then when you see it, you go, "Oh, that's how generational wealth has been created because they had the house, they paid off the house, they either bought another house or
They
bought a
pass it on to
second
their kids.
house,
They
passed
pass
it
it.
on to their
That's
kids,
right.
and
Yeah.
then you're like, "I get it
Yeah.
now."
Yeah.
You've been able to capture wealth through real estate,
That's right.
as opposed to, waiting for the random stock or whatever it was.
That's exactly right.
And so you're talking about a product with a group of people to create a generational wealth that, hasn't been attainable except for doing what you said earlier. You sell,
You play
and
the
all of that.
game.
Yeah,
Yeah.
yeah, yeah.
It's funny, right? Hey, I tell people like, "Well, what do you do?" I'm like, we're building wealth for the middle class, and we
Mhm.
just so happen to be in the real estate arena to do so.
Right, right.
You could have substitute real estate arena for any other thing because our core purpose, right, and our fundamental reason for our why is, you're exactly what you just said, and it is to build that
Mhm.
long-term generational wealth. We just created a very turnkey solution that you don't have to think about at
Yeah.
all to be able to do it, and it just so happens to be on your home,
Mhm.
right? And that's where sometimes we talk to agents, they're like, "Okay, yeah, you get into the brass tacks of, like, the mechanics of how it works," which is great. But sometimes we just gotta level ourselves up a little bit and think of it as a holistic view, which is, okay, I get this financing. Well, why? Well, the why is because your client as an agent, guess what? They're gonna be wealthier in the future. And if they have more wealth, what
Yeah.
does that mean for you?
Right,
A
right.
possibility that they can either buy a new house, possibility that they can
Mhm,
do that. It when you rising tide lifts all boats. You've heard
mhm.
that.
Well, but you also are giving people the ability to invest in their own ideas, companies, whatever. I mean,
That's
you can
exactly right.
create
That's
business
exactly
when you've
Yeah.
generated this wealth.
That's
Yes.
exactly right.
Yeah.
This isn't just about, my father's an entrepreneur, I go back to him again. He unfortunately got crushed during 2008. And my dad has always been an entrepreneur, right? He worked for himself. Selling his home and I'm not, he sold his home, all those reasons of what happened in his life, he didn't get another chance to go and become entrepreneurial again because he's
Mhm.
chasing the paper.
Yep. Yep.
He's chasing the paper. He doesn't have time to be able to do it. I guarantee you, my father's um, emotion, his
Mhm.
energy, his mindset, and his creativity would have been just better knowing he
Yeah.
had this extra couple $100,000. As an example,
Right.
think of how many people, and this is where you go to the emotional tug. That's why I said in the beginning is security that we provide.
Mhm.
When you have a little bit of security, when you know you got something there that's going to
Yeah.
be brewing and it's going to be accumulating, when you live your day to day and you think about it, doesn't that give you a sense of, let me be proactive?
Yeah. Yeah.
Let me whether it's creating a new business, starting an online,
Yep.
what you call it, Shopify store,
Yeah.
whether it's not even making money, but just having time
Yeah.
to learn how to do whatever you wanna do. Security allows
Mhm.
for that, right?
Yes.
And and a lot of people can't because they don't have it because 'cause they're in the rat race.
Yeah. Yeah.
And
Yep.
again, this is where I bring up to my dad. My dad, if he had the money, even though he's 73 or he was be 93, if he had the ability where he didn't have to be in the rat race right now, I guarantee you he would have started a business.
Mhm.
And he could have started a business. There's no age. And I'm not saying everyone should start a business. I'm just trying to say that like
Yeah.
the possibilities
Yes.
of
The
what we're
ripples of
opening
this.
up
Yes.
for your future
Yeah.
are endless. And that's all we're trying to do. And yet some people, and we see this right now, and I understand, you know, that again, we're new and whatnot, but we also have sometimes we got some agents out there, just to be candid. We got some real estate agents who want to feel like, no, they just want to sell. And we're just
Uh-huh.
like, no, you mean like you're costing them money by not even listening to this, right? Let them decide. And sometimes some of the homeowners, we've had some homeowners, most homeowners are just like, this is, and if I could do this, please, please, please. But you got some people out there sometimes, the fear of the unknown, right? So again, I heard this analogy actually by my better half where, everyone's a tree. Have you heard of that before?
Uh-uh.
Um, Trees you look at every tree, they're different, right? Some trees reach to the sun, right? Because that's how they grow. Some trees shy away from the sun because they don't need the sun. Some need more water. Some have stem, whatever. Everyone's a tree. Everyone's a little different. So this isn't going to be a solution for everybody. But if you want to build a better life for your future and you want to build wealth and you want to build security
Yeah.
for your future or for your offspring, if you're older, your kids can get the house. You
Yeah.
want to be able to build this future with some security on an asset that has already made you money.
Right. Right.
It isn't like we're saying,
Yeah.
"Go
Yeah.
invest in
Right. Going
Bitcoin."
into a different market, a different city with an
Yeah, it's not like we're
unknown.
saying, yeah,
Yeah.
exactly.
Yeah.
It's not like we were saying
Yep.
go into the new UAE, stock market
Right.
in, Dubai. We're
Yeah.
not
Yeah.
saying that. We're saying
Right.
this is a home that you walk the floors
Yeah.
on, right? You bought it for 300, you sold it for
Correct.
it's
You
now
know
worth
it's worth
500.
500. You know it could be worth 800 if you could hold on. Yeah. And it's doing the exact same thing for that first time home buyer. So it's the very same wealth generation. It's the very same, like you're speaking to stability, you're speaking to economic attainment. So all of those things that's happening for a first time home buyer,
Okay.
you're just doing it now for the middle class or however you want to categorize that group of people.
And that is and we say middle class because and I think, like I said, the middle class, I don't think anyone can define what the middle class is today.
Yeah.
I don't think
Whatever,
anyone can
however you,
answer
right, right.
what it is today. If you
Yeah.
said so in the 90s, I can tell
Yeah.
you what it was. If you say in today, I don't think anyone really has a true definition of the middle class. They can tell you what upper class is, and they
Yeah.
can tell you what lower. No one
Yeah,
really
yeah,
knows what the middle
exactly.
is.
Well, and even when you threw out the salaries, some people would be like, "Oh my gosh, 200,000." Well, you know what? If they're under crushing debt from medical debt, that 200,000 doesn't do much. And
Yeah.
so, it is all the middle class definition is can be a question mark.
It's
Yes.
a question mark, and I think the way that we would look at it today is you you're doing okay, but you don't
Uh-huh.
you're not doing great, and like you're a pitch away from like striking
Yeah.
out, you know, in
Yeah.
the sense,
Yeah.
and that is the hard part about this. And so if like we can add this other now bonus wealth account. So again, if you think about it, look at it as like this bonus wealth account, and the account is your home, and now you've got another tool as a financial tool for you. Now I will say this on the first time home buyer side, bonus is about building wealth for the middle class, right? We also want to be able to, we also believe in the asset economy. Again, that's what we're doing, right? Hold on to appreciating assets. We want to be able to, over time, help first time, help tenants be able to start earning equity and be able to get equity right off the bat. I've rented, my father didn't buy a house. He came here during the revolution. My parents are from Iran. He came during the revolution in the 70s. He
Mhm.
didn't own a house until 2005.
Hmm.
That was 30 years, okay?
Wow.
We rented
Yeah.
forever. We rented so many times, and all that money we spent for 30 years on rent,
Yeah. Yep.
right? And I always was like, "Oh my gosh, this is a." So, what we wanna do is we evolve. Our goal is to be able to get, um, roughly 10 to 30,000 over the next decade or so. I would say 10 to 50,000. That's kind of a thing, 5 to 10 years, 10 to 50,000 homeowners, we call them members, bonus members,
Yeah.
that have bonus their home across the country, okay? With that, we will have deployed anywhere between, on average, 100 to 250,000 per home, so that's, you know, a lot of
Yeah.
money, billions of
Yep.
dollars. And then we would have created additional 3 to $5 billion of wealth on those families that they have. So they got the
Mm.
billion that they got in the front, and then another
Right.
3 to $5
Right.
billion
Right.
dollars for those families that
The
they'll have
future.
in the
Yep.
future that they never would have had
Yeah.
otherwise. That's our mission. That's our goal for V1. What we wanna do then as well is we wanna be able to, if you pay rent, and we could do this once we have the bonus kind of ecosystem of the houses and whatnot, you wanna pay rent, your $2,000, and you're gonna pay market rent to bonus, by the way. We don't mark up rent to tenants. We don't do any of that kind of stuff. It's just, this isn't some of the, you've seen some of these propco companies that have, you know, first time home buyer, but then they charge
Yeah.
$800 higher than the market
Yeah.
rent.
Yeah.
And that doesn't work. You are literally, it doesn't work. What I should say is that you're stretching a person to rent a property so that they can maybe buy later on. What we wanna do is we wanna say, "You're gonna pay market rent for this house, and if it's a bonus house, you're gonna pay market rent. The part of the proceeds of the rent that you put in, the $2,200, nothing more, you're not putting in extra, part of those, you're gonna build equity." Now, renters can get into the equity game. And that is where we wanna start evolving, 'cause that's been something of
Mm.
kind of like where I have,
Yeah.
you know, like I said, for me, my life has been a two-act journey. It's been this act of like, we've been a renter and we never owned anything, and we never owned anything for a long period of time, and then my dad finally buys a house at a time when I already had left the home, right? I was already 25 years old. I was like, "All right, too late now." Um solve for that eventually, but really the middle class, and really trying to empower these people, empower all of us, again, middle class as well, and be able to help people to, do something that they wouldn't have been able to do, but become fully alive. I mean, there's an emotional piece to all of this,
Yeah.
right?
Yeah.
Financial transaction. There is there's an ethos to this story, and there's an ethos to what we're trying to do and unlock. And we just, you know, we want people who wanna go on that journey with us, and that's the reason why we call our homeowners members, because they're literally going on this journey with us as partners on these assets, to one day where they're just like, all of a sudden, like, I can't believe it. I mean, we just had a homeowner. I know I'm going off the dovetail here, but we just had a homeowner. It's fascinating. We did her house in 2022, okay? And by the way, past couple of years, and I think her house was in Mesa. Past couple of years, home prices haven't gone up that much. Her house surprisingly has gone up, a little bit more than the average. Her house now got in for 400, um, and we cashed out her equity, $150,000. That's what she had. Her house now is worth 480, as of we did this January 25th.
Mm.
In 2 years.
Wow. Yeah.
She's
Wow.
already got like $20,000 of wealth built she didn't even know about, and she hasn't even done anything, and it's only been
Hmm.
2 years. And so
Right.
it's like, you're like, you talk to her, you're just like, she's like, "This is really?" Well, yeah,
Yeah.
you
Yeah.
know? Her next question was, "Well, can I pull it out right now?" But we're like, "No, we're gonna let it ride.
Right. Right. Well,
Don't sell too soon," right? But
and it
that is
used to be you'd have to put a ton of money in it to get to that level, but
not right now. So
No, and this is
yeah,
it. And so this is what I'm excited about. This has been something that I feel I've been all the things I've done have kind of like led me to this to be able to do
leading up
this.
to this. Yeah.
And although I'm not in this, I mean, I love technology and that was my I love it a lot and we are doing a lot of technology in here. Um, Housing is just so near and dear. And we got all this creative around AI and whatnot, which is awesome. But nothing is gonna take away from shelter, and
Right.
nothing is gonna take away
Correct.
from this appreciating asset.
Yep.
It is real property, it's stuck on the ground, no matter what ends up happening, if robots take over the world, you're still gonna have this house under there. They like you living in it, but you still have this house in there.
Core basic need. Correct.
That's right.
Well, Kyle, thank you for joining us today. Bonus Homes, we are looking forward to great things because you guys are really, it's one of the reasons we have this podcast is to feature innovators and true change makers. I hate to use the word influencers because, it kind of has that whatever image, but
Right, I can't even influence my better half.
I know, right? So,
I am the anti-influencer
I
of
don't know. We need to
influencers.
reclaim that word, but innovators, change makers, and influencers. But I do appreciate you bringing this to the conversation.
Great questions and thoughts too. I really appreciate the conversation. Thanks for having me on.
Thanks for listening to Changemakers with Katie Gore. To find out more about Katie, go to quadel.com. That's QUADEL.com. This has been a production of Forbes Books Radio.